Hello friends, welcome to my YouTube channel at One Raj Kamal. As you go through this video, please do subscribe and press the bell icon so that you can see regular updates as more videos are posted here. Last week saw a pretty quiet first half, but intense volatility over Thursday and Friday. Overall, Dow Jones was nearly up 1.15%, while S&P 500 and Nasdaq were down. S&P 500 down 1.55%, and Nasdaq down 3.11%, as you can see on this chart. On Thursday, actually post a scorching high CPI data. When everyone expected the markets to tank, Dow Jones went up by over 924 points or 3.16%, as you can see here. And similarly, S&P 500, reflecting across the board behavior, went up by over 92 points or nearly 2.6%, as you can see on this chart. But half of these gains were given up on Friday, when actually retail sales showed stagnant numbers and everybody thought that the gains of Thursday would continue on Friday. The reality is that on Friday, as you can see here, Dow Jones went down by 1.34%, S&P went down by 2.37%, and Nasdaq went down by a whopping 3.08%. The only truth in markets today is volatility. This was the week of inflation data. Wednesday or 12th October saw PPI numbers come out and they were higher than expectations. PPI increased month on month 0.4%, while core PPI increased month on month by 0.3%. The key takeaway was that producer price index is now at levels which is likely to pressure profit margins of companies and possibly have a negative pass-through to the consumer, implying more inflation ahead. Thursday or 13th October saw the CPI numbers come out. CPI was up 0.4% month on month in September. Core CPI, which excludes food and energy, was up 0.6% on a year-on-year basis. Total CPI is up to 8.2% now versus 8.3% in August, while core CPI is at 6.6% versus 6.3% in August. Core CPI is now at its highest level in 40 years since 1982. See on this chart. The details of the September CPI report were also not pretty. The food index is up 11.2% year on year. The energy index is up 19.8% year on year. And the shelter index is up 6.6% year over year. Shelter has one of the largest contributions to the CPI data. It's nearly 32% plus. As a result of these scorching high inflation numbers, the expectations of a 75 basis points hike in the next Fed meeting in the Fed funds rate were cemented, as you can see here. And now the peak Fed funds rate is expected to be 450 to 475 basis points. Most market participants argue that this is the toughest market that they have ever seen, and they are not off the mark. See on this chart, the days of 1% volatility in either direction in 2022 is now at 99 days. And unlike 2020, more days have been on the downside, and this has been more protracted in the sense that it's been far more spread out compared to 2020, which saw most intense down activity till March and then up activity thereafter. The days of correction in 2022 stand at 133, as you can see here. And this means days when the market is down 10% or more from its all-time highs. This hasn't happened in a long time. Overall, S&P 500 now is 18 business days back to back in bear market territory. And this means more than 20% down compared to all-time highs. In this market environment, if I can at all sound positive, the only thing I will say is that I feel that the bottom is near. High interest rates that we are witnessing in the US will kill rental and home prices. That will trigger a decline in the inflation rate in the shelter index, and that will potentially trigger a peak inflation narrative in core CPI, and we can all look forward from there then. Thank you.